What's up, guys? So I'm going to be showing you guys the power of trading one time frame, right? And I'm going to be limiting this to one particular entry model, right? It's very popular. There's been different names for this model, but I'm keeping it simple and taking us back to the basics. So basically, I'm just going to start this video by saying there is no particular way to trade the forex market. What works for trader A may not necessarily work for trader B. So to further expatiate on what I'm trying to say, there's this popular saying that trade from the higher time frames, or the higher time frames paint the bigger picture of the market, right? But then there's also this fact that what happens on the higher time frame is going to start building the blocks from the lower time frame. So if you can interpret the lower time frames, you'll be able to know what the higher time frame is going to do. So it goes both ways. So not to waste any further time, I'm just going to get into the video. So basically, I'm going to be talking about the breaker block, to be particular, the breaker block. I'm going to try to keep this video very short and precise. So now we all know what a breaker block is, right? But let me just reiterate for those who may not know. So a breaker block is simply when you have price moving like this, right? Creating impulses and corrections, right? These particular demand or supply levels, right? That pump price to break this structure or these highs, old highs or old lows are what we call our order blocks, right? So now this here is an order block, right? Now, typically, we'd be expecting price to come back to react from the order block and then go, right? But what if we get price coming to our zone and then rapidly taking out the order block? Now, when we have something like this is now a scenario where an order block has failed, and we term this particular level, this particular demand level now, a breaker block. So I'm going to say this, an order block, right? Now a breaker block. So that level is still very important. Now, the key to this thing that most people don't pay any interest to or any importance to is once they've seen their breaker block, they just wait for price to just come back and they expect price to just sell. Now, the question many people will ask is, do I get in here, right? Where do I keep my stop loss? Do I keep my stop loss? Because ideally, this is the breaker block, right? You can say this is the breaker block. So do I keep my stop loss here, right? Do I keep my stop loss here? Where do I keep my stop loss? So I'm here to solve that question for you guys. So I've created like a model that I've used. I'm still using right now. Explaining how I would go about this. So right now we have our breaker block, right? What I would love to see, I would love to see an inducement just after that breaker block has been formed. I love to see an inducement, right? Price may play around, right? I love to see an inducement. Then when price comes here, once price takes out this inducement and does not tap into the breaker block, and then takes out this external range liquidity, right? If price comes back to tap the breaker block, I would consider that an invalid setup. Well, why will I do that? Because price has fulfilled the objectives of the breaker block. You understand? Price has swept internal range liquidity, which is this inducement here. I'm just going to label that IDM. That's taken out the inducement, which is the internal range liquidity, and then swept the external range liquidity. Now, I'm not trying to use any fancy term here. I'm just going to keep it simple. So price created a lower low, right? This is a lower high, right? This is a lower high. This is a lower low, right? Then price came here, faked out people, right? And then came to create a new lower low. And if price comes back here, I'm not expecting this breaker block to hold again. We may end up seeing a new breaker block. We may end up seeing a new breaker block form. So sorry, let me just keep that nice and clean. So we may end up seeing a new breaker block from here, right? And then we expect inducement to be formed, and then for price to come and then go. So this is just the whole concept. Now, I'm just going to be doing this on the 15 minutes time frame. Forget about all this whole monthly, weekly, daily, and all that time, because most times people get confused trying to correlate the monthly, weekly, daily, higher time frames to interpret what they will do on lower time frames. So it gets confusing. I know many people are struggling with this. So what I do is I just pick a time frame that suits my personality. I'm someone who likes to see trades more frequently, right? But there has to be a balance. I don't want to see too many setups, and I also want to see a handful of setups. So the 15 minute time frame is like a very fine time frame for day trading, which is what I personally do. So right now, I'm just going to show you a few setups that I've marked out. I'm going to explain with that. So currently now I'm on a buy on gold, right? I'm going to explain this. I'm going to explain that later in the video. So now if you can look at this, right? So let's do this. Just looking at the 15 minutes time frame. One other key thing that you have to pay attention to is most times you'd see something like this, where a week goes below the low and then goes back up, right? There was nobody close below this level. So I'm not going to tag that as a breaker block if this high is taken out, right? Personally, the trick I like to do is I like to switch to the line chart. Once I can see a lower low, and then price takes out this high, that's a confirmed breaker block for me. So that's what I like to do. Now, when I've gotten that, I need to see that once we have a break, an impulsive break, it must be impulsive, guys. It must be impulsive. Once I have an impulsive break, I would love to see the next candle not tap into the breaker block yet. I would love to see a candle that is just going to more or less like create like a gap from here to the breaker block. So like this kind of like range, I would like to see that gap, right? And then price may play around, play around, play around. So what I'm just going to do is now, some people will actually say they would like to enter from here, but ideally if you're entering from here, then your stop loss should be somewhere here. And I like to target like the external range liquidity, right? Or just 1 to 3, keeping it safe, right? Now, but then some people want to be more conservative and keep their stop loss below the low. And if you're targeting a 1 to 3, you would obviously get stopped out. But if you're targeting the standard liquidity, you barely get like a 1 to 2. And I prefer to keep it to a constant 1 to 3. Now, so what do I do, right? I like to take it more conservative by waiting for a confirmation entry. So once price taps into that zone, right, I'm zooming into that POI, which is the breaker block, and I'm expecting price to just take out the high of any of these candles. Now, this candle tapped here, so this is the high that I'll be looking for. As soon as price takes out that high, I'll put a buy stop, right? And my stop loss is just going to be few pips below this low. And then as you can see, right, if I target the external range liquidity, I'm having a 1 to 6 hour, or I could just get 1 to 3 very fast and I'm out of the market. So that's one example. So let me explain with another example. Guys, so yeah, these we have this particular one again. As you can see, this should have been what a demand level on another block. Price came in, right? And what did price do? Price impulsively took out the other block, right? The next candle did not tap this zone. So we have this as our inducement. Price comes in. Now, if you were somebody who was aggressive and takes entry off the breaker block and your stop loss is here, you'd have been stopped out. Where would you have kept your stop loss? That would have been safe, be somewhere here, right? But then you'd still not be able to secure a 1 to 3, right? So what do I do personally, right? What I like to do is, like I told you guys, I want to see a candle, a bearish candle take out one of these bullish candle lows. And exactly as soon as we see that, which is here, I'm in, and my stop loss just goes few pips above this. And as you can see, targeting the external range liquidity, I get a 1 to 3, right? And I'm out of the trade. So that's one. Then another example would definitely be this. As you can see, this was a supply level, right? Expecting price to sell. It impulsively took that level out, right? The next candle, which was this, didn't take that out. We had all this build up. Price finally came, took out the inducement, right? If you were an aggressive person, and you took your entry from here, with your stops here, you'd have been taken out, right? If you were conservative, your stops here, you barely escape with a 1 to 2, right? But using the approach that I use, right? Once price takes out this particular high, you get in there, your stop goes below the low, just a bit below the low, and then you're going to get in for a 1 to 3, as you can see, right? So that is basically how I perceive the market. Now, guys, all this is just like, and I think in a span of two weeks, right? I think I have another example. Yeah, let me show you one more example, right? Back to back, guys. So back to back. So we have this, right? This was a supply level, right? Price impulsively took it out, as you can see, right? The next candle didn't come back down, right? Price came back here. But as soon as you take your entry, just as soon as it takes out that candle's high, then keep your stop loss below the low, just a few pips below the low, and you go for a 1 to 3. And as you can see, beautiful, beautiful. So, guys, this is just trading on the 15 minutes time frame. I'm not taking into consideration the 1 hour, the daily, the monthly, and as you can see, on the 23rd, which was on Monday, you had 3R. On the 25th, which was on Tuesday, you had 3R. On the 26th, which was on Wednesday, you had another 3R. You didn't have a trade on Thursday, you didn't have a trade on Friday, right? And all just patience, guys. And then on March 4th of March, we had a trade on Friday, and which went well. Now currently I am buying gold, right? I'm currently buying gold. Um, this is the entry, right? Now this one is quite different. This one was, as you can see, this was the entry. Once price took out this candle, I just got in a buy stop and I'm holding price now. I kept my stop loss here just for some particular reasons. But once price takes out this external range liquidity, I'll take out some positions and break even this trade and allow price to do its thing. So yeah, basically that's what I'm doing. As you can see, it's a breakout block. As you can see, the inducement and then price came and it went. So yeah, that's basically this what this video is all about. So if you love this video, please make sure to share to your friends. Comment more topics that you want me to create content on, and I'll see you guys in the next video. Thank you, guys.